Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Friday morning, last day of what has been basically a very, very hectic week. It's a holiday-shortened week. But guys, did you feel like there was a holiday in between?
They did not feel like a holiday. In fact, the way the markets moved, it looked like there were 3 more days added to this week this time around. But, you know, the good part is that not only is it the last day of the week, but it's also the first day of a new series. And a lot is riding on the September series in terms of news, cues, and a lot of the developments that may so happen. We'll discuss all of that, I think.
Absolutely. And even festivities galore. They continue as the Ganesh festival revelries are all over. Plus, of course, the big bonanza, and we'll spend a lot of time today on the show talking about it. Tim C's story, all the possible GST cuts that have been moved in that bill. Of course, what comes through the council, we'll see. But I think it just adds to the festive fervor if indeed some of those cuts come through.
Largely all mostly on expected lines.
Yes.
Is what we are what I saw, auto, cement,
Yes.
consumer durables, etc.
Daily consumption items coming down to 5%.
We also just have to look at the couple of details that may come by in the sense that how much of that is without input tax credit, with input tax credit. So I think a lot of the chartered accountants this
9:30 a.m.
after
when ask the question. We'll have to
put a lot of pen to paper, I guess.
We'll have the details coming up. Let's just quickly get to what you need to know as we begin the session. So first up, right, US equities, I'll start there, jumped to a record high. Basically from the session lows, markets recovered quite a bit. And solid economic data, which we will refer to. So S&P was up 1/3%, NASDAQ was up about 0.5%. The 10-year macro market's quiet. 10-year yield down about 3 basis points. Oil was up about 0.5%, so nothing very much. So the data, second quarter GDP was revised up from 3% to 3.3%. The expectation was that it'll be revised up to 3.1%. So it was a beat. And the jobless claims number, which the market got in the US, was also pretty benign. You'd wonder with this kind of data and this kind of macro market reaction, etc., why was the dollar, why did the dollar go the other way? The dollar index was down 0.5%. So we are now under 98, 97.9. The 50-day moving average is around that 98 level for the dollar index. So actually, the weak dollar is one of the strongest opinions out there on Wall Street. The dollar will weaken. On pretty much else, there is a fair bit of debate, etc. But I think there is in using a political term, bipartisan kind of consensus that the dollar perhaps is headed lower. We'll see. But this is important for us as well. It's a determinant. I mean, it's not that it's mattered quite a bit. FIRs have been still big sellers, and we'll get to flows, etc. in just a bit from now. But keep an eye on this one. Now, a Fed governor, Lisa Cook, of course, filed a lawsuit against Trump. She pushed back earlier as well when Trump said, well, she has to go. Later today, we get core inflation, July core PCE inflation. That's essentially what the Fed's favorite inflation gauge is. Monday is a market holiday in the US. Cash markets are closed, futures are open, but they shut early. So in that sense, I mean, you're going into a US-less sort of weekend when you come back on Monday. Market positioning, and Mangalam, of course, will look at the F&O stats more closely. But a cursory sort of glance with the expiry yesterday suggests that the positioning, etc., is largely similar. FIs continue to sell about $4.5 billion in cash. Locals continue to buy about $9.5 billion in cash. But FIs continue to add to and build index shorts. $600 million worth of index shorts added in this particular series. And of course, the retail public seems to be pretty upbeat with the index long addition, etc. As I said, more granular data with Mangalam in a bit from now. Of course, I mean, now we are running into the September 3rd, 4th GST meeting. Center is proposed, and we'll put all those rates, etc. As I said, they're largely in line with expectations. So I'm not going into details here. Timsy will address that in just a bit from now. But that's the trigger. The big overhang still remains, of course, that 50% tariff from the US. And how the market will be able to navigate that, I think, is the real question. Without a doubt, I think that remains the bugbear for markets, which I think will prevent any upsides. Will the market sell off from here is the question, and that brings me to levels here. So we basically on the Nifty closed firmly below the 20-day moving average. As of day before yesterday's close, we were kind of just under it, hovering around it, but yesterday's close broke it decisively. I put this level out yesterday as well. First stop is 24,337, which is the 8th of August low. And I think that's the first stop. Bank Nifty is close to a weekly lower band, which is 53,563. The support here is the 50%. If this goes, that is 53,563. The 50% retracement of the rise comes into view, which is 52,692, 52,700. Basically, it becomes a support target, however you want to look at. And of course, I mean, the 20 days, the trailing upward level, which is 56,370 for the Nifty Bank as well. So just, I mean, some levels to work with as we kick this last session for the week out. GIFT Nifty will give you a sense of how we are starting, about 14, 15 odd points higher. So it's quieter as compared to what we had yesterday morning. Mangalam is with us on the wall with the F&O stats. Mangalam.
Well, I'll set the September series up for you first by telling you what happened in the August series. We saw a range of nearly 1,000 odd points, and thereafter the August series, the Nifty ended about 270 points lower, taking July and August losses to a cumulative over 1,000 points. And as we enter September series, history tells you that September series is actually known for big moves on either side. So September 2021, we had a near 1,000-point move. Then there was a 700-point decline the next September. Last September itself, we saw a near 1,100-point move on the upside on the Nifty. So this series is known for big moves. And known for big moves, what are the positionings suggesting right now? You know, the rollovers have been on the higher side, telling you that the conviction on the short side has been higher, 84% versus 78%. Even the open interest on the Nifty at the start of the series at 1.6 crore shares is higher than the 3-month average of 1.44 crore shares. So higher rollovers, higher conviction. What does that imply? It implies that those who were bears have actually increased their bearish positions. Prashant just said that, you know, the FI positioning hasn't changed. Well, it has for the obverse. In fact, at the start of the August series, the FIs were just 10% long, and now they are just 8% long. And 8% FII long exposure is actually the lowest in terms of long exposure at the start of the new series. Ever since the NSE has started revealing that data, that net exposure is nearly 1.7 lakh contracts on the short side. Who are the counterparties to the FIs? We have our domestic retail clients and HNIs, 72% long exposure, 1.27 lakh net long exposure for them as well. Is FII shorting necessarily a bad thing? Perhaps not, because I was looking at data. You know, in April 2023, the FIs were long at just 9%. Over the next 4 series, we saw a 2,600-point move on the upside on the Nifty. November 2023 and Feb 2025, the FIs started the series with just 11% long exposure. The next 2 to 5 series, we saw 2,300 to 2,900 points on the way up for the Nifty. So not necessarily a bad thing, especially given the triggers that we have going forward as well. So the last 2 series, we've seen an 1,100-point decline on the Nifty. Now we start with the biggest trigger. Today we have Reliance AGM. With the sheer weight of the stock on the index, any positive news could spur a bit of a rally. Then we have the GST rate rationalization, India-US trade talks. Even as the overhang continues, any sort of resolution may trigger a bit of a rally. We'll watch out for that. And thereafter, towards the second half of the month, we have the US FOMC outcome that will come by. The first rate cut is expected out there. You'll see pre-festive buying, and also keep an eye out on impact of heavy rains on demand on the ground. So all these factors together will be ingredients for the September series. Known for big moves, the FI is just about 8% long.
Okay, well, let's take a look at what's happening across the Asian markets. And Asian markets are mixed shade, actually, as we speak. Some of the markets, China, Hong Kong, for instance, they're still flashing green. There's some profit-taking going on in Japan. There was inflation data that came out of Tokyo today. And the rise in inflation is not as much as what was anticipated. So those are some updates. By the way, on FPIs, and I'll put up that data in just a bit. The FPI cash market trends are really interesting, and they've simply mirrored the delays that have taken place in the India-US trade deal, which of course still hasn't seen the light of the day. And as we're rounding up this month of August, the selling is almost 29,000 crores in the cash market. So it's progressively increased from July. And I will put the numbers up in just a bit. Let's get started then with the equity call of the morning. Chris Wood of Jefferies says Jerome Powell's Jackson Hole speech has been interpreted as dovish by the markets. He says the message conveyed was that the Federal Reserve will prioritize the labor market over inflation. He adds if the likelihood of a 25 basis points cut on September 17 has risen, this also means that the next payroll data due to be announced on September 5 has become more important than usual. Meanwhile, he says the inflationary pressures from tariffs are only just starting to show up. On India, he says one change will be made in the India long-only equity portfolio this week. The investments in Aditya Birla Real Estate will be removed and replaced with an investment in M&M. So that's Chris Wood saying that they're giving a thumbs up to M&M in that portfolio change. Well, let's take the conversation forward. Folk Heen, senior investment strategist at Standard Chartered Bank, is with us. Folk, great to have you with us. So, I just want to focus exactly on this, on how you're looking at a market like India now, because it's been underperforming, the currency has been under pressure as well, and that trade deal is still elusive. But do you think the worst is already factored in the way prices are shaping up here in India, or could there be further downsides?
Yeah, hi. Morning. Good to be here. Thanks for having me. I mean, yeah, we do get a lot of questions about India from clients asking, is it a good time now? It's pulled back. Is it a good opportunity to add aggressively? Look, I think we are looking at it as a core holding. We think it is good for the medium term. But in the short term, the headwinds, sure, you have tariffs, but I think we all know that for the equity index, sales in the US is just about 8%. So India's the revenue and earnings is very much domestically focused. So the direct impact is not so great, actually, in terms of the sales in the US. And even then, a lot of its IT services, pharma, which is exempted from tariffs at the moment. So it could affect sentiment in terms of the headlines that we're getting. It could affect currency volatility, in fact, the risk sentiment there. But fundamentally, the tariff impact, in terms of the direct impact, is not so much of a concern. But what is more of a concern we see actually is the earnings revision. And earnings revision actually has been negative. And we saw that post-earnings season, it is still negative. And for a growth market like India with a high valuation, we think that we really need to see earnings momentum pick up and earnings revision turn positive. In order for flows to come back in there. So we do still like, I think, the medium-term story, and the earnings growth is still at very high levels, I think mid to low teens at the moment. So it is still good on an absolute basis. It's just that the momentum is still a bit weak in the near term. So what we are saying actually to a lot of clients, investors, is that it is good to accumulate for the long term, but in the near term, because of this, I think you don't have to be aggressive in terms of accumulating it. It is a core holding for us within Asia. And the preference at the moment we have within Asia is with China and Korea, where valuations are a bit more attractive. And so that is our preference at the moment within Asia ex-Japan.
So you prefer China and Korea to India right now, but India, you believe, is a part of your core holdings and you would like to accumulate at current levels, and the momentum is not on the side of the bulls for India. But what about, the markers that you're watching out for that may perhaps turn the momentum and make you a little more attracted to India versus, say, something like a China or Korea?
Yeah, I think the markers, the key one really would be earnings revision. I think we see that valuation has come down, and it is off its peak, but compared to the 10-year average, for instance, it is still above the average. So valuation hasn't really come back yet. But look, I think in the past, we've seen India being at high valuation and still being able to perform well. And it's really because of the earnings story. And we think that, the tax cuts that has been trying to implement by Modi and the government, that is supportive for consumption. But we're not seeing that flow through yet in terms of the earnings. So I think it's really back to earnings revision. That's the key thing that we see. On a relative basis as well, of course, with China and Korea, those markets have been doing well recently and this year. And I think that a lot of it is because of the valuation. It is still cheap. And then the catalyst in terms of the AI investments and what they are doing with DeepSeek previously, that really spurred a re-rating in China. So in China, it's a re-rating of the valuation, really. From the AI developments and policy stimulus. And then in Korea, it has done very well, but we still see more to come. I think the government there with the KOSPI 5,000 target, then the improvements in corporate governance. So again, valuation is still cheap there at a big discount. So on a relative basis, we still see a bit more momentum for these two markets. relative to India. But India is something we watch very closely because the medium-term story is great, but it's just getting the short-term headwinds. Once we see earnings revision turn positive, I think that would be a good time to get in there.
Okay, all right, Fook, we'll leave it on that note. Shorter conversation today, but thank you very much for giving that important view on how you're looking at India amidst some of the other regional markets as well. Thanks for joining in. We'll take a very quick break, come back on the other side. More news and updates coming in, including our spotlight on the big story, GST cuts. What can be expected and how will the market perhaps interpret all of this? Back with that in just a moment. Welcome back. Well, let's get to that big story as promised. Our sources in the government are indicating that the group of ministers on rate rationalization is likely to table the centre's proposal to do away with the 12% as well as a 28% slab. So what we're talking about essentially is a two-tier GST structure. Timsy has a lot of details on at least what the proposals are. Which are the key items, key categories which could shift perhaps lower to 5% and where the tax incidence perhaps could go higher? Timsy, tell us more.
Well, that's right. What sources are indicating to us that the upcoming GST Council meet, which is scheduled to meet on 3rd and 4th of September, the centre's proposal on rate rationalization is up on the agenda, and the group of ministers on rate rationalization has put forward the centre's proposal, which includes reducing GST on hotel accommodation of less than or equal to 7,500 rupees per night from current 12% with ITC to 5% without ITC. Beauty and physical well-being services proposed to be reduced from 18% with ITC to 5% with ITC. Admission to cinematography films where prices are less than 100 rupees are likely to be proposed to be reduced from 12% with ITC to 5% with ITC. The proposal is also to hike rates on services from 28% with ITC to 40% with ITC on admissions to casinos, race clubs, sporting events like IPL, race club services, betting, casinos, gambling, horse racing, lottery. On the other hand, when it comes to the business class air travel, over there we are likely to see a hike from current 12% with ITC to 18% with ITC. The centre's proposal is also to reduce certain items from 28% to 18%, which includes cement, which is a key item there. Also, there's a proposal on transportation sector, which includes cars, automobiles. Over there, something that we need to know. Petrol, LPG and CNG driven motor vehicles of engine capacity not more than 1200 cc and less than 4000 millimeter length proposed to be reduced from 28% to 18%. Diesel driven motor vehicles up to 1500 cc and up to 4000 millimeter length proposed to be reduced from 28% to 18%. Three-wheeled vehicles proposed to be reduced from 28% to 18%. Motorcycle of engine capacity not exceeding 350 cc proposed to be reduced from 28% to 18%. The parts, automobile parts, accessories for motor vehicles proposed to be reduced from 28% to 18%. Where there's a hike on this particular sector, station wagons, racing cars, motor vehicles of more than 1200 cc and 4000 millimeter of length to see a hike from 28 to 40. Aircrafts, helicopters, aeroplanes for personal use, yacht, other vessels, motorcycles with more than 350 cc, again a hike from 28% to 40%. Let's see what all happens when the council meets.
A comprehensive list out there, Timsy. Thanks a lot for that. Let's see indeed what actually does come by. But you've given us a fair indication of what is on the minds of those who are making the decisions out there and how that would impact or what would the implications of this be. At 9:35 a.m. today, stay tuned to CNBC TV18. We have Najib Shah, who is the former chairman of the Central Board of Excise and Customs, joining us along with Prateek Jain of PwC. He will join us as the group of ministers on rate rationalization is likely to table the centre's proposal on the two-rate structure. But for now, let's get the stock impact of GST developments with Gurmeet Chadda, Managing Partner, CIO, Complete Circle. We'll also connect with Jyoti Gupta, Research Analyst at Nirmal Bang Institutional Equities. Gurmeet, morning. Always a pleasure speaking with you. What do you think have been the highlights out here? I mean, I was looking at some of the hotel business because, 7,500 rupees from 12% turns to 5%, but it's the with and without input tax credit that makes a bit of a difference. Of everything that Timsi suggested could be on everyone's mind, what are some of the standout features for you?
Yeah, hi, Mangam. Good morning. Always a pleasure. I think, some of the measures are obviously welcome. See, the private final consumption accounts for 60% of the GDP. So any boost in consumption along with income tax cuts which have come in, as well as the welfare benefits government has done in the rural part especially, will augur well. But I just hope that there are not too many, rejig rather than final cuts. So eventually you want more money in the hands of consumer and not too much of a rejig just to compensate moving items from, let's say, 28 to 18 and or 12 to 5, and then, so I don't want to see too many things in the 40% slab because that will then dampen the spirit, because luxury consumption is something which has also been a contributor at the margin. I think cement clearly looks to be a winner. I also think two-wheelers clearly and smaller cars seems to be a winner. I think paper, textiles, especially apparel, less than. I think there's a price threshold getting increased to 2,500. So, your retailers will gain. I think what could probably be a bit of a dampener could be more things in the 40% slab. So that's what I want to do. Hotel, I think, is travel and hotel has been one of the top themes as far as consumption is concerned. We have lemon tree in the portfolio. There's been very sharp movement in the stock in anticipation of what is going to come. So as far as 5% slab comes without ITC, I think it's fine. I think more importantly, Mangalam, from a broader consumption theme, the inverted duty structure needs a look. See, there are a lot of classification disputes also in GST. If you meet any GST tax consultants, they'll tell you. Second, because of the inverted duty structure, again, there are a lot of host issues. So you want input and output, taxes to be aligned so that broader benefits gets passed on.
Got that. Gurmeet, good morning. And Jyoti, good morning to you as well. We'll do, let's take sector by sector, right? And Jyoti, thanks for joining us. For cement, right, what we're picking up is that the centre is proposing that the GST rate be cut from 28 to 18%. What does it mean for companies? What does it mean for stocks that you cover, Jyoti?
Hi, thank you so much for having me on the show. So there are two parts to it. While currently, if you see the demand is anyways muted, it's anyways going to pick up over the quarters. It's a seasonal impact. But when it comes to GST, there are two parts to GST. When you're reducing it from 20 to 80, it will have some impact on the operating incomes of the company, and that could be offset by increase in demand in the later part of the year, maybe next year. But if you ask me positive, yes, you could have extra money in the hands of the consumers, but that does it mean immediate, coming back into the economy in terms of cement consumption? Maybe, but with a lag. But not
Jyoti, have you done any sensitivity analysis on if, say, prices were lower by 5%, how much do volumes increase by? Prices were lower by 8%, how much do volumes increase by? And the other side, because if the GST is coming down from 28% to 18%, one would impact a price rationalization of at least 3 to 4%, right?
Actually, this kind of sensitivity is possible only if you have a consistent demand. That's where you see, if the demand goes down, if the prices goes down by 5 rupees, then possibly the demand would increase by 2%. But in India, cement is it doesn't follow that kind of trend. And if you are reducing the GST, and in a scenario where demand for a full year is expected to be around 6 to 7% and not around 9 to 10%, I think what I'm going to see is, anyways, South has already seen a rollback of almost like 15 to 20 rupees, while the rest of regions are already a reduction of 3 to 4 rupees. But that's an ongoing basis. It's part of the industry. So, in fact, the industry has already taken an increase in prices in the South region by 20 to 30, and that should eventually get, absorbed in the quarter.
So, short point is that this news by itself does not make you tweak your estimates or your model.
Absolutely not, because I've already taken in a very base case scenario. Even if that happens, it's not going to spike the demand. I don't see 7% or 6% going to 10%. even if it happens, maybe it could happen with a lag, and possibly you may see an impact in FY27. But if you ask me in terms of the impact of GST on the operating income, yes, the companies which have just recently commissioned and plants in 1 to 2 years, last 1 or 2 years, and likely to have, they will possibly see some impact within their from the GST.
In terms of cost workings, etc. Got that. Jyoti, just coming back to you, Gurmeet, autos, because that's where the focus is, right? Has been from a market point of view as well. Stocks, by the way, have done well. If you just look at this series that just expired yesterday. Small cars, 28% to 18%, right? Then the other bit is for luxury cars, which is greater than 1200cc, there is a hike to 40, but GST is already 40. There is plus a cess. So the logical assumption is that the rate will be 40 and the cess will be subsumed. Because right now, effective rate is up north of 55%. If that is the case, if cess is subsumed and the rate is 40, and since the market has moved to these larger cars, 1200cc plus, do you think it'll be it'll give a big fillip? And by the way, for parts, seats, accessories, and these graphics will come up. The proposal is to cut from 28 to 18%. So just run us through the three segments and what you would do from a stock point of view. Small cars, luxury cars, and auto components.
Sure, Prashant. So I don't think so, the effective price. I think effectively the price would be slightly lesser or same as far as the above 1200cc is concerned. I'm not too sure on the extreme luxury end, which could be, let's say above a certain price threshold, and not just the engine, like, with the Beamer and the Mercs of the world. So starting from the lower end, so for example, two-wheelers, I think, are a big beneficiary. I think and that's coupled with good rural demand. We're already seeing month on month two-wheeler numbers being better than, four-wheelers. So and there is some valuation comfort. May not be as much in TVS because TVS has got re-rated over a period of time. But even in the Bajaj Auto, it's sub 9,000. Hero also, despite the run-up, you're getting it at, mid-teens in terms of valuation. So any pickup there with good festive demand coming, price reduction, something in the hand, lower rates, all of that combines well. Ancillaries will benefit. We've already seen Uno Minda made a new high yesterday. 40-45% of the product mix is towards two-wheelers. We saw Lumax made a new high at 42,4,300. Then there are companies like Sandhar Technologies, which have a larger two-wheeler portfolio. They make frames for the bike. They make locks. They are now coming up with the fabrication products as well. So you got to map the value chain there. I think the two-wheelers and tractors, to me, tractors again, I think it may move down from maybe effective rate can move down. It's already, I think, at 18. It can come down to 5. So I think 12, if I'm not wrong. So that's another one we want to look at, especially the farm equipments as well. Four-wheelers, I think, barring Maruti, we'll have to see. As I said, we'll have to see. It's not negative. My sense is it will be positive, and cess would be removed. Only the effective rate would be less than what the final rate is today. So M&M, I think, remains a top pick. I also think now M&M is the second largest player, Prashant. Now it's above of Hyundai, and I'm doing a lot of. One of my clients is one of the largest dealers for M&M in North. I think despite this rates announcements, one segment, one car maker where the demand is still holding up better than others is M&M. So SUVs, I think they're at 27% market share.
Yeah, and there's still more positive calls coming in. We had one from Chris Wood of Jefferies just today. They've added M&M to the portfolio, making some changes. So even at these levels, there are people showing the thumbs up on M&M. Got that point. Gurmeet, on consumer, what would the, what should the approach be from a stock perspective? Because I was reading on a whole host of a lot of things, including, for instance, toothpaste, talcum powder, hair oil, shampoo, dental floss, soap. All of it is moving from 18% to 5% if these proposals go through. On the flip side, you have caffeinated beverages, carbonated beverages containing fruit juice, etc. They could be moving up to the 40%, sin level. So purely from a consumer standpoint, then of course there are, durables, consumer durables, ACs, etc., where again it could be cut from 28% to 18%. Now, how much is left in terms of the stock play? If you look at the last 1 month, for instance, a stock like Blue Star is up 8%, Trent is up 4%. but a lot of others haven't moved at all. So purely from a consumer stocks perspective, what would you buy? And if there is something that you perhaps really need to avoid now, I don't know, if Varun Beverages has an overhang now, for instance, if this goes to 40%.
I think so we need to divide it between core and tactical. I think tactical, some of it could be FMCG. We've seen some run up in HUL after some decent numbers, right? And stock hasn't done anything for 3 years. Nestle, again, because the food portion is higher. You have to also see where the packaged food could benefit, right? Within FMCG, you have to also break it down. So something like a Nestle, like a Tata Consumer, which has less carbonated drinks, more beverages, something like even a BKG, where probably the food portion would be 65-70% maybe. So that could come under a more core portfolio with enhanced demand. Similarly, something like Trent, where the price point is not more than $9.99. Stock has corrected from 8,000 odd levels to 5,000. Still expensive, but growing. You get that 25-30% growth. Market needs to see growth in this kind of environment. So that could be there in the portfolio. I think hotels, travel platforms as well. And something like an internal, Swiggy, Nykas of the world. So I think you play that in terms of core, new age, traditional, and then there is a structural demand coming. Tactical could be, some of the names which haven't done well in FMCG, where I don't see 10% volume growth coming back. You can have a Lever, you can have a Daburs of the world, and play tactically. And then, once you've made enough money, maybe move out of it.
So to sum it up, Gurmeet, the best way to play these upcoming GST cuts, you would say some auto names like M&M. I mean, leave us with your top 3-4 names.
So, I think two-wheelers, Bajaj Auto and TVS and Uno Minda in terms of ancillary. You can take M&M and in four-wheelers, maybe a bit of Maruti. Again, hasn't done much if you see last 6-7 years. Platform play, Eternal, Swiggy and Nykas of the world. And I also think Geo Finance, some of the NBFCs will come part of this as a broader consumption play. And travel. Any further price correction in Indigos of the world is again welcome.
Very useful, very, very useful, Gurmeet. Thank you for joining us early morning and appreciate you being with us. Jyoti, thank you very much with that very sharp view on cement as well. So thanks, both of you, for being here. What we'll do is we'll just run you through, just shift for one with the focus to commodities and what's top of mind there. Manisha is joining us for a quick sense of that. We'll go across to her. Manisha, morning.
Thank you for that, Prashant. I'll start with the crude oil prices, where we've seen almost a 1% of gain overnight. Well, crude oil prices have had a lot going for itself. To begin with, the U.S. crude inventories have seen a very sharp decline. You have gasoline trading at a 4-week highs in the U.S. market. And then the Russia-Ukraine have stepped up attacks on each other's energy sector and infrastructure as well. And the markets are now looking at a weakness in U.S. dollar index as well. That in turn also has been supportive, not just for energy, but many of these metal names as well. So you have gold prices trading at a 5-week highs. Silver in the Indian markets is trading at an all-time high. It's a strong gain coming back for the ferrous metals, where steel and iron ore prices gained up overnight as China is looking to curb production for steel between 2025 and 26, supporting both of these metals there.
Right, take that point. Manisha, thanks a lot for that. Let's get to the top brokerage calls of the day. Sudarshan joins in with his list.
So, good morning. So, Kotak Institutional Equities has upgraded Clean Science and it has upgraded to buy call, and target has given of 1370. It believes that risk-reward ratio for the company is now favorable, and the stock has fallen 20% last 1 month after 24% stake was sold by founding family. It believes that company also has healthy pipeline of projects and believes that stock might move upward going forward. Next one is Apollo Hospitals. HSBC has a buy call and target here is 8,520 per share. It says hospital segment stands on a firm ground and volume and efficiency are sustaining the growth, and focus areas going forward are going to be progress in 24/7 cost break-even and corporate simplification of corporate structure. Jefferies has written on consumer financials. It says loan demand stays subdued. Stress has increased across sectors, including MSMEs, due to slowing macro. But it has also talked about some of the positives. GST rationalization can lift demand in select segments and aid small truck operators, and pick up in economic activity and lower rates should ease pressure in H2, and that may help in net interest margin, and it sees an expansion in NIM in H2. And top picks remain Bajaj Finance, Chola Investment and Shriram Finance, and Muthoot Finance for Jefferies remains a defensive play.
Okay, all right. So we'll keep all of those stocks on our radar. Thanks for that. More brokerage views coming in and some model portfolio changes. And there are changes both in Jefferies, as we just saw in that equity call this morning, as well as Morgan Stanley's made some changes. Let's bring in Nimesh to understand what's going in and what's going out. Nimesh.
I said, it's not more about what's going in and what's going out, but I believe autos will be in focus. Of course, we've reported about the GST rate cuts, but interestingly, both the big global strategists, Chris Wood and Jonathan Garner, have added the Indian auto names into their respective model portfolio. I'll start with Morgan Stanley first. So Jonathan Garner has today added Maruti to their GEM as well as the Asia Pacific focus list. Now, they believe that Maruti is likely to benefit, is going to be the biggest beneficiary of the GST reforms because 50% of their volumes coming in the small cars, and also the earnings have started improving. And the Morgan Stanley India auto analyst believes that Maruti can deliver double-digit revenue growth in FY26. So that's a big call on which they've added Maruti to the focus list. Coming on Chris Wood. Chris Wood has written a note today, and he's added M&M to the India long-only portfolio by replacing Aditya Birla Real Estate. So two big additions in the auto names in India from two big strategists, and both are from the auto sector. So autos will benefit not only from the GST rate cut, but the push coming in from the big global strategists as well. So Maruti and M&M will be in focus in today's market.
Okay, all right. Nimesh got that. Thanks very much. So we'll keep those stocks on our radar. We need to take a quick break. On the other side, we get to our first corporate conversation of the day. Samhi Hotels is the company we're putting the spotlight on. The management will join in to talk about an agreement that they've signed to lease 260 rooms, mid-scale hotel in Hyderabad's financial district. So we'll find out more with Ashish Jhakanwala in just a bit.
Back, you're watching us here on Bazaar Morning Call. Let's get our first corporate conversation underway. Samhi Hotels, the company signed an agreement to lease its 260-room mid-scale hotel in Hyderabad. Ashish Jhakanwala, who's the chairman and managing director, along the CEO of the company, joins us now. But beyond just this, we'll focus on three important points. One, the annual revenue, obviously, from the Hyderabad hotel. What's the investment, the ROI out there? But more importantly, the second quarter, can we expect some sort of improvement in occupancies and ARR? And most importantly, the impact of GST rate rationalization, as it were, as Tim C has been pointing out for the hotels itself. Ashish, thank you so much. Let's take the last talking point first, which is the GST rate rationalization impact. What we gather from our sources is that there could be, for rooms upwards or up to 7,500 rupees, which are currently 12% with input tax credit, we moved to 5% without input tax credit. How does that change things for you? Because, 5% without input tax credit, a lot of people would say is similar or perhaps worse to 12% with input tax credit.
So I think GST, people are taking a very myopic view of the impact on the hotel sector by looking at what direct impact will it have on the hotels, depending on the average room rates. And you're absolutely right. I think the devil is always in the detail. So we do need to see how the text looks, whether the input tax credit is there or not there. But listen, what's more important is that the rationalization of the GST will necessarily boost domestic demand. And that will have a significant impact on, the occupancies and the demand for the hotel rooms. I am keenly watching the text of finally what comes for the hotel sector. Well, one good news is, and this I understand this whole about input tax credit, but the good news for Samhi is that a lot of our hotels are in mid-scale portfolio and will therefore benefit if the tax rate was to go down to 5%. But a bigger excitement which spans across the portfolio is that the boost it gives to domestic demand. And Samhi as a company today, over 75% of our business comes from domestic market. Just about 25% comes from international. So I think overall, we need to look at the net impact of GST on our business, not just through the room rate, but also through who the consumers are for the business.
But Ashish, take your point completely, but just to understand this, out of your total keys right now, could you give us a rough percentage to work with? How many would be where the ARR, average room rate, is just below 7,500, if indeed that becomes the threshold?
So, please, what I think in terms of number of keys, you will actually see over 65% of our rooms coming from hotels which would sell less than 7,500 rupees. This would be all Holiday Inn Express, bunch of Fairfield by Marriott's. But in terms of revenue contribution, I would think about 45% of our revenue, because they tend to have lesser revenue per key. But 45%, 50% of our revenues will come from hotels which have an average rate of less than 7,500. I mean, again, let's be cautious. We need to really understand the subtext, because our business is highly variable. We do end up pricing a room thrice over in a single day. And in the same day, a room can be priced in the morning at 7.5 and in the evening at 8,500 rupees, right? So I would advise caution about when people start interpreting the impact of GST on our sector. But what does not need interpretation is that the domestic demand, if that get boosted, I think we have a lot of gains coming, post October.
Sometimes between clicks, the room rate changes. Ashish, hi, morning. But for a moment, right, that number is useful as a framework to think broadly. I mean, and we will not hold you to exact numbers. But what could be the impact? I mean, it's not just the GST on hotel rooms, but also, I mean, it's a cumulative impact. I understand that. But as you see it now, over a 12-month period, what could this do if these are the rates that we put out?
And if it is 5% without input tax credit, that could be detrimental overall, wouldn't it? Or I mean, just spell it out for us on what it could mean if there is no ITC and a bulk of your inventory is at 5%.
Yeah, so I think, when it comes to the impact of GST and this whole component of input tax credit, right? As I mentioned, I think generally the reduction in the GST will be very helpful, irrespective of how the ITC is treated, really. Of course, it'll be really helpful if this new caveat is not inserted, because then you get the real direct benefit. But I think, if we were to ignore ITC for a moment, because we exactly don't know how they're trying to interpret that, but we really think that the reduction in the GST, both for our sector and sectors that feed demand into us, could probably add another 10-15% to our total demand,
All right. 15% to a total demand.
That's
this
right.
is, got that.
In terms of revenue, Prashant, in terms of revenue. So I meant in terms of revenue, actually,
10-15% to your revenues.
Correct.
Okay, and this is with ex-ITC as
That's
well.
right. That's right.
All right. Okay. Take that point. So that's about the GST. We'll obviously await, clarity on this once the text is out, and obviously, we'll ask you to join us then as well. We've taken that promise from you. But for now, the 260-room hotels that you've signed an agreement for in Hyderabad, you are looking to invest about 125 to 140 crores on fit-outs, etc. out there as well. What do you think would be the annual revenue of, this hotel? By when does it start getting accumulated? Because I was doing some rough math here. A 260-room property, if it does about 75% occupancy at 5,500 to 6,000 rupees a room, because it's mid-scale, you would do about 30 to 40 crores in terms of annual incremental revenue. Would that be fair?
I love how you don't need hotel consultants nowadays, But no, I think the concept that we're looking at in Hyderabad is currently at an average rate of about 7,500-8,000 rupees. We expect this hotel to deliver a top line of about 70 to 80 crores with a net margin, property level net margin of about 42-43%. Don't forget, this is a variable leased asset, which means a percentage of the revenue will be paid out as a rent to the owner. So adjusted for that, we would expect that we would potentially get to about 30 to 35 odd crores of net operating profit from this hotel. So it's about a 70 to 75 crore top line asset. It's a great location right next to the under construction Google campus. I think we're very excited about the prospects of this. 70
to 75 crore. And how much do you pay as rent as a proportion of sales?
We don't want to disclose exact numbers, but in the zip code of about 12 to 13, little bit around 12%.
All right, Ashish, always a pleasure speaking with you. 12 to 13% is what you perhaps would be paying as rent on this hotel. Could be a 70 to 75 crore revenue property, which may add about 35 crores to your profitability over a period of time. We will obviously await details coming in from the GST Council on the rates for hotels. With that, we'll take a short break, come back, discuss more on the markets, fundamental stock talk lined up with Devin Choksi. Stay with us.
Okay, welcome back. I think Devin Choksi is with us, Managing Director at GR Choksi FinServ. Devin, good morning. Thanks for waiting. Appreciate you joining us. Devin, the story, of course, that we broke last evening is the GST rate cut and the specifics which the centre has proposed. I just want to make it clear that everything we are putting out is, of course, everything which the centre is proposing. The GST Council has to decide on it, and they're meeting, of course, early September 3rd and 4th. Your sort of top 3-4 ideas based off what we've been discussing, what you've seen we put out, Devin, what benefits the most, and where do you think stocks have upside?
Yeah, Prashant, good morning. Well, interestingly, I think we have been putting our focus on the discretionary spending, and probably I think we are more comfortable with auto ancillaries at this point of time. Believe that I think there is an inherent proposition for growth in this particular area of activity because of two factors. One, higher amount of disposable surplus in the hands of individuals, and also I think the lower interest cost, which is basically allowing people to spend money, I think, through their borrowings as far as I think the buying of the vehicle is concerned. And on the top of it, if one is getting the advantage of lower GST, particularly in the premium models of some of the four-wheelers, the OEMs, I believe that I think that could possibly be signaling the larger amount of profitability portion for some of these companies because they will be assuming certain amount of pricing power due to the GST, I think, benefit available to them. So in my viewpoint, I think the business condition looks really which could possibly benefit more.
Okay. Hi, Devin. Good morning. Great to have you on the show today. So we've discussed a lot of GST, of course, but the other big event of the day, of course, is the Reliance AGM. And shareholders are, of course, going to watch out for a lot of announcements and perhaps look out for any cues or clues, if at all, in terms of more value unlocking and maybe that Jio IPO, if at all we get any indications of that. So, Devin, let's do one thing. I think we've got Rima joining in with a quick synopsis, a quick heads up of what can be expected from a market perspective. And then we'll ask Devin about the stock. Rima.
So the AGM is always important because it sets the tone for the company's growth for the next year. And very often we've had big bang announcements. So what is it that the street expects? One, timeline on the Jio and the retail IPO. This was first mentioned by Mukesh Ambani in 2019. He said an IPO will happen in 5 years, but that was pushed back as the company is more focused on strengthening the business. Secondly, in the last AGM, Mr. Mukesh Ambani laid out an ambitious roadmap, doubling Reliance Industries, by FY30. It also included doubling retail and Jio in the next 3 to 4 years. So how does the company get there? Then thirdly, on the new energy, because new energy is seen as the next big growth driver. So clarity on timelines, how much can it contribute to overall Reliance's financials, the earnings potential? Fourthly, expansion plans. The company is always big on expansion. So whether it's in retail in terms of fast fashion, quick commerce, in terms of the digital side of the business, whether it's on the space side, more than 40% of the subscribers are already on 5G. They have an ambitious plan of hitting 100 million broadband subscribers. And even on the pure O2C, the traditional business, the company has lined up massive capacity expansion. And finally, in terms of the stock price, it's up 14% in 2025, but it's still 11% below its 52-week high of 1551.
Okay, all right, Rima, thanks very much. Just a reminder, so the AGM kicks off at 2 o'clock today, and we'll be live with the coverage 1:30 onwards right here on CNBC-TV18. So all the perspective, all the views on the direction ahead of the company and its various businesses, all of that. So we go live 1:30 onwards. Devin, now you tell us, what's your call in terms of, any major announcements that you're watching out for, and of course, a view on the stock as well.
Yes, agree. Well, I believe that I think the important part here would be that you already have the consumer-facing businesses with about 50% contribution to the EBITDA, and balance 50% comes from the industrial businesses, including oil to gas and oil to chemical businesses and exploration businesses. So I think from a perspective of looking at the consumer-facing businesses separately getting listed, it's a good chance that one could possibly ask for that 25,000 crore worth of EBITDA in the retail business, 65,000 crore EBITDA in the Jio platform business, put together about 90,000 crore kind of a position against the overall total EBITDA of around 175,000, 178,000 crore for the other businesses included together. I believe that I think this is one area where probably I think one would be very keenly looking at when they get listed. Should Geo platform get listed with even 5% dilution, assuming that about 10 lakh crore kind of a market cap they assume? I believe that I think this would be the largest listing that one could possibly go for at around 50,000 crore kind of a fundraise on 5% dilution. So in my viewpoint, I think this is going to be an interesting proposition, not only from the listing, but also from attracting some of the large investors globally into this particular space. So really keen to look at some of these things unfolding. Along with, I think the AI implementation that they have been doing, which is giving them the advantage of implementing some of the businesses faster and giving them confidence to double the size in 3 to 4 years' time from now. That is what I think one is keenly looking at as to how they're implementing the AI part in each and every business vertical. So these are the two areas where I'm keenly observing some of the developments.
All right, Devin, thank you very much for joining us. Quicker conversation, but useful as always. And we'll have you back after the Reliance AGM. And of course, that's at about 1:30 today afternoon. We'll take a quick commercial break here. We're going to come back and we'll get you some technical trading ideas. Sudeep Shah and Vinay Rajani are going to be with us on the other side. Stay tuned.
Welcome back. You're watching us here on Bazaar Morning Call. Less than 15 minutes to go for market opening. We have the pre-open rates coming in right now as well. We'll wait for them to settle. It's just been about 15 odd seconds. So in the meanwhile, let's go to our technical experts. Sudeep Shah and Vinay Rajani join in now. Obviously, these are rates that you can totally ignore. A 280-point downtick, not one step in line with what the GIFT Nifty is indicating. And obviously, early days in the pre-open as well. So we'll watch out for where it settles. The GIFT Nifty was suggesting a 15-16 point uptick. Let's get in Sudeep and Vinay. Sudeep, good morning. Yesterday, there was a big gash. In fact, over the last two trading sessions, the Nifty is now firmly below the 20-day moving average. Where does it go from here? And with the kind of FII positioning that there is at the start of this series, do you see any upside triggers, or do you think it's consolidation in the ground, perhaps lower?
Good morning, Mangalam. Mangalam, absolutely. The last point which you just mentioned about the FII positioning is extremely important here, because if we see, this was one series, the August series, wherein the FII positioning was somewhere around 10 to 15% on the long side, and this is the lowest that we have seen sustaining for the entire month in last several months now. In fact, over 1.5 to 2 years. So this is one important point that we cannot miss, and we need, rather than just trying to do any bottom fishing or trying to buy on every dip, I guess we should be now just eyeing for some important resistances on the upside and let that cross, and then one should start positioning properly on the long side. So for me, that level now would be 24,730, 24,750 on the upside, slightly positional, but yes, this is an important level which needs to get crossed for a revival of the upside. Now on the downside, 24,300, 24,350, the mid-month, the initial part of the August series where there were few lows printed over there around 24,300. Now that becomes a very important support zone. So in case we sustain below this 24,300, then further downside up to 24,000 also cannot be ruled out. So all in all, while the current pre-opening also is suggesting some kind of a minor downtick, 24,300 initially will act as a support, and below that 24,000, 24,050 also is quite likely.
Okay, all right. I think now we're settling down, but just 2 minutes into the pre-open session still, so I think we'll have to give it some more time. Gentlemen, good morning. Vinay, what about you? How are you looking at trade?
Yeah, good morning. So basically 670 points fall in last 5 trading session in the Nifty. So definitely technically market is looking weak as it is placed below the key moving averages, and derivative rollover data is not also not suggesting any encouraging data for the bulls. So Bank Nifty especially has seen a 50% higher short rollover in the Bank Nifty. So it is looking weak. But at the same time, as we have been discussing, the FI's long to short ratio, almost 92% of their position in the index future has been on the short side. So that is also can act as a contrarian indicator once any positive news or positive sentiment turns. So basically, there is a support around, as Sudeep suggests, there is a support around 24,300, which happens to be around the 200 days EMA in the previous swing low. So there is a weakness, but I think immediately we can see Nifty going towards 24,300, and after that I'm expecting a pullback rally and bounce back. And in bounce back, we need to see whether it is crossing the crucial hurdles. As of now, we are asking our traders to hold on to their short position with a stop loss of 24,700, which is yesterday's high. So yes, it is looking weak. As far as trading ideas are concerned, Musgao Dock is looking weak. So September future can be shorted around 2626. I would suggest a stop loss at 2675. On the downside, 2550 should be the target. And second pick can be taken in the HCL Tech on the short side, which is looking weak. So 1448 was the yesterday's close in September future. 1478 should be the stop loss, and 1410 should be the target on the downside.
All right. And Sudeep, your individual stock picks, what would they be?
Mangalam, two stocks now, both of them have been doing well in the August series where the markets have been negative. So the first one is Titan. Stock, if we see on the weekly as well as the daily charts, is on a sustained uptrend. The weekly charts suggest that 3,300, 3,400 has acted as a support, and since then, last 3 weeks, we have seen a stable uptick in this, and the stock is almost at the highest level of the month. What we feel is that from the current levels, 3580 could act as a decent support on the downside till 3580, 3585 holds. On the upside, Titan could see levels of 3700, 3730. The second stock that is there on our radar is Polycab. Now, even this is one outperformer in the last series. While a lot of mid-caps have seen battering, this stock has held on to its important support zone closer to 6,700, 6,750 and has broken out above 7,000 on the upside. So we feel now from here on, this zone of 7,000, which was the breakout zone, will act as an important support. And this stock could be bought with a stop loss at 7,100. The upside targets, the stop loss would be 7,000 and the upside targets would be 72.60 as well as 73.30.
Okay, all right. Sudeep and Vinay, thank you very much, both of you, for joining us with that, with those trades, the setup, and of course, what to do. Now things are improving a little bit. We're down about, 18 points on the Nifty. The sensex is down about 85 points. Some delivery data. Hormuz is here with the big moves yesterday, and were they backed up with delivery stats? Hormuz, morning.
Morning, Prashant. And Vardhaman Textiles, we spoke about the stock yesterday on closing bell as well. And the volumes that we saw yesterday on that 13-14% surge, almost 2.5 crore shares. Never before has the stock traded in such volumes in a single trading session. And the 20-day average in comparison to the 2.7 crore shares traded is just 5.75 lakh. So it shows the heavy volumes, but the delivery volumes, only 4% of those total, that is around 12 lakh shares were marked for delivery out of that 2.7 crore that were traded, compared to a 20-day average of just 1 lakh shares. Now, Reliance India is the other one. The reason for highlighting these two names, the next two ones, are the fact that the stocks moving higher are doing so on very strong volumes, but the stocks falling are not doing so. Now, Reliance is down 11% in the last two sessions. Yesterday's traded volumes, 10.5 lakh shares, lower than the 20-day average, and the delivery volumes of 4.2 lakh in line with the 20-day average. So not higher or not lower either. CSB Bank 2 was a stock that was declining on lower volumes. Yesterday was down 5.5%. The Tuesday's volumes were higher because of the inclusion in the MSCI, and that was the adjustments that were related to it. But yesterday we saw around 3.9 lakh shares. The 20-day average is just 7.1 lakh, and the delivery volumes as well, only 1.7 lakh were marked for delivery, compared to, which is half of the 20-day average of around 3.5 lakh. A stock bucking the trend in this regard is Vishnu Prakash Punglia. That fell yesterday on very strong volumes. 13 lakh shares were traded yesterday, 20-day average of 4 lakh, and almost 6.6 lakh shares marked for delivery, compared to a 20-day average of just 1.5 lakh. And the stock, as a result, has now slipped below its key moving averages, and it's even hurtling lower towards its IPO price of 99 rupees.
Okay, so Vishnu Prakash, not too much Prakash, at least on the upside. All right. Thanks very much for that. 7% decline this week. Thanks for that, Hormas. Let's quickly get to Nimesh now. He's here with the standout brokerage note of the morning. Nimesh, which one is it?
As Surabhi said, today's standout is on financials. A big report from UBS, and from a stock specific, they've upgraded Kotak Mahindra Bank to a buy. I'll come to that, but first on the overall sector, UBS believes that the financial sector profit pool is likely to double in the next 5 years. So that's a big call. And within that, they expect the non-lending businesses, which is the AMCs, the wealth managements, they are likely to outperform and outgrow by nearly 1.5 to 1.7 times compared to the traditional lending businesses. So on back of that, which is why they've upgraded Kotak Mahindra Bank to a buy. In fact, within the NBFCs, they prefer Chola as well as PFC, and within the insurance space, they like SBI Life. So that's overall in the financial sector. Now, coming specific to Kotak Mahindra Bank, as I said, UBS has upgraded the stock to a buy from neutral, and they've raised the target price in Kotak Mahindra Bank to 24.50. They believe that Kotak is the best play on the financial services space thanks to their various subsidiaries. So that's what they believe. From a margin and cost perspective, they expect the gradual ease going forward. And on the back of superior growth and superior ROA, they expect the re-rating to continue in Kotak Mahindra Bank. So a big report on financials, but within that, they've upgraded Kotak Mahindra Bank to a buy now with a target price of 24.50.
All right.
Okay, all right.
Thanks very much for that. I just want to, just pull up 3 stocks. We should look at what the pre-open has ended. We should put up Maruti and Mahindra. This is, of course, on the back of the GST, all the changes we've been discussing from 8 o'clock. Maruti is flat. Mahindra is down 0.4%. Maybe a Uno Minda, auto parts, right? Gurmeet was talking about where, of course, 28 goes to 18%. Nothing very much at all so far. Okay, let's look at Lemon Tree. We had Samhi Hotels with us, but Lemon Tree, under 7,500 rupees a night, 12 becomes 5% without ITC, 2% higher on Lemon Tree. I mean, this is representative of the sector. We'll look at others as well. Maybe look at PVR. But here, I mean, it's just for cinema tickets priced under $100, 12% to 5%. Nothing very much. Look at Indigo as well, where for business premium class, 12 goes to 18% with ITC. And maybe just like 1 or 2 cement names where GST is being cut from 28 to 18%. This is, there are various, you can look at sector by sector implications, etc. But broadly, this is well telegraphed, which we've been reporting for the last, of course, this has now gone through as a proposal and that's an exclusive which we broke. But in the sense of what we reported in terms of actual changes sector by sector, these are largely in line with expectations, market expectations. So remember that as you look at these stocks opening up. Surabhi.
And also, Prashant, if you just look at the market over the last 1.5 odd weeks since the 15th of August, which is when the first announcement happened, and we had a big pop immediately after that. And then the law of marginal diminishing utility seems to be being applied, because if you see reactions across the board, even shoemakers like, whether it's Bata or Liberty, because the threshold in the proposal is that it could be increased to 2,500. You're seeing 1.5% kind of moves, 0.5% here and there. Nothing very dramatic because of GST. But let's stay with the same conversation, because we know that consumer durables could be a big beneficiary as well if indeed that proposal of reducing the GST rate from 28%, further down to 18% actually comes through. Hiten Mistry, sector lead consumer at Aquarius Capital, is with us. Then, how would you look at the whole durable space? Some of the stocks like Blue Star, I was looking at it earlier, it's already rallied 8% this month, I think, in anticipation. But will this be a meaningful fillip in demand? Because anyway, at least the AC makers have had a really rough start to the year.
So hi, morning, Surabhi, and thank you for having me. I'll tell you about the sectors 28% to 18%. Certainly, it's a positive impact, Surabhi, and it is poised to make consumer durables more affordable and thereby stimulating demand and enabling industry growth. So I'll quickly tell you, like, consumer durables divided into 3 things: white goods, brown goods, and consumer electronics. Brown goods, which are small appliances, microwave, cooking range. Consumer electronics consist audio and video devices. Both comes under 18%, so there is no significant momentum there. But strong momentum may come in a white good, which consists like washing machine, AC, refrigerator, etc. And certainly because average order value for that also on a higher side, right? So certainly this changes will increase, and anticipated demand is high. And not only to the consumer, but I believe business and overall Indian economy will also encouraging consumer-led growth.
Right. How much will the rate cuts impact demand by? How much would the incremental revenue, according to you, be for all these products?
Yeah, so I believe that 12 to 15% additional demand should come in this particular category where it's fetching 28% GST.
So your analysis for this year, your projections for this year for the festive season stand increased by how much, if at all the rates are announced with effect immediately on September 4th, say?
Yeah, so see, considerable optimism regarding this substantial increase in consumer durable during this festive season also, plus the rate cuts also. As I mentioned, 12 to 15% additional demand may pump up for this.
12 to 15% additional demand.
That's for the annual this thing. So festive season obviously increases by a lot more because of seasonality, right?
Seasonality, yeah, correct. But festive season may sorry.
Go ahead.
So, go on.
Yeah, so you'll see that festive demand you'll see in the third quarter because we are already at August month, which is in quarter 2. So that demand you may see in the third quarter. But overall, you'll say at annual level, 12 to 15% additional pump up will come for sure.
And how much upside in stocks, Hiten? I mean, looking at valuations, ultimately that's what people want. I mean, if this is meaningful demand bump up, mera stock chalega ke nahi chalega. So when we're talking about the durable space.
So as a compliant, I can't speak about stock, but for the sector specific, I'm very, very bullish on the consumer durable segment.
You know the reason why we ask you about festive season specifically and not the annual, because the first part of this year was impacted by unseasonal rains, right? So you think that this cut will make do all the losses that we saw in the previous part of this year, which is the first and the second quarter so far?
Yeah. So see, I mean, consumer durables, it's not like so as I mentioned that 12 to 15% as an annual level. But if you see the festive season
Right. I'm sorry, I have to butt in. We will continue this conversation. Apologies, we're just hitting market open. First rate starting to come through, 24,495. The bank nifty is absolutely flat. The sensex is flat. The small cap index is yet to open. That's not 1.5% down. It'll just start to, there you go. So now it's slightly higher. It's absolutely flat actually. So first rate starting to come through. Mid cap index is up about 22 odd points as well. Now we'll start to do this, stock spotting, right? What's moving? How much is moving? Across sectors on the back of GST and otherwise in just a bit. The Nifty heat map is up on your screen. You've got 35 odd names which are higher. The rest of them are down in the red. And Kotak Bharti on one end, and there is Mahindra and Shriram Finance on the other end. Shriram Finance, by the way, was one of the big losers yesterday as well, meaningful losers yesterday as well. 50 higher on the Nifty now, so 24,545. Surbhi.
Shriram Finance, Prashant, this week has lost about 8%. So perhaps it has something to do with some inputs talking about stress building up in MSME and if there is a second order effect of tariffs, etc. Perhaps that could explain some of it, but there's a meaningful decline on the stock this week, down another 0.5% today. The other one that's actually started lower is Mahindra & Mahindra. Despite all the positive brokerage notes and Jefferies turning optimistic on the stock, it's opening down about 2%. M&M has also lost about 5%. For this week. But overall, the Nifty is not looking bad at 40 points higher. So let's see what's taking it higher. A whole bunch of consumer stocks. There's Nestle, there's ITC, there is Lever, there is Asian Paints. If you look at autos, and names like Tata Motors are doing actually pretty okay. Geo Finance is up about 0.5%. Tata Steel, by the way, there have been in reports about China cutting back on its steel capacity to reduce the overcapacity and the glut in the market. That seems to be favoring names like Tata Steel as well. Reliance ahead of the AGM up about 0.5%. So all in all, fairly strong. And Kotak, of course, reacting to the positive brokerage commentary as well, up 1.5%. So overall, it's not a bad start at all for the Nifty. Mangalam.
Not a bad start at all for the Nifty. For the broader markets as well, we have nearly 3 stocks advancing for every stock which is declining. Obviously, it's early days of the open itself, but it's a secular FMCG rally that we're seeing. Colgate is up around 2.5% in the broader markets. We have Dabur, which is 1.5% higher. Godrej Consumer, another one which is about 1.5% higher as well. On the way down, we do have Nykaa, which is down about 2.5%. Paytm is also seeing some bit of profit taking. And thereafter, we have SBI Card and Phoenix Mills, both of them down by about 1.5% and 2 each. PNG Health from the broader markets has been doing well all through, pre-open as well. This month it's up around 12%, currently sitting with a gain of close to 5%, and we have, some sort of volumes building up on that one too. Relaxo Footwears, there is expected to be some relief coming in at the lower end of the footwear segment for GST, and Relaxo Footwear obviously has the lowest average selling price in the listed footwear universe. So that stock up around 4.5%, has been a struggler when it comes to returns to shareholders. So maybe some bit of bump up is what we're seeing from the lows. Bata is another one which is up around 2.5%. Even though the company is looking to premiumize their portfolio, a large part still comes in from the sub 1,000 rupee category. So that stock too is up around 2% right now. Then you have names like Force Motors. Prashant was speaking about the auto space. Cartrade Tech is the other one which is up 3%. And Kitex Garments is the one which has announced, a new plant that they'll start producing from the Telangana plant. So that stock is up around 4% after seeing a big gash this week. It's down about 12% for the week despite the 4% up move that we're seeing right now. By and large, more stocks advancing than the number of stocks which are declining.
No, absolutely. And, we'll spot more as we kind of sort of go along. But it's 24,540 on the Nifty at this point in time. And we're about 30 odd points in the green. Let me welcome in Tahir Badshah, who's with us. Tahir is Chief Investment Officer at Invesco Mutual Fund. Tahir, good morning. Great to have you with us here. We've spent the last hour or so talking about the what we broke yesterday in terms of the story, specific proposals from the government to the GST Council on what the centre would like to see. Of course, the GST Council has to decide. What to your mind, Tahir, from a GST perspective, which sector, I'm sure you discussed this internally, what's your thought process? Where will this show up the most meaningfully? And distill it down to sectors from a stock market point of view. Tahir.
Yeah, Prashant, so I think it's quite obvious, and there's been a lot already discussed around this, and we know that essentially the slabs which are merging, which is basically the 28% and the 12%. Those are the ones which are actually going to see the maximum amount of benefit. And by and large, I think what has been conveyed and also been supported by the council is that most of the items in these two categories will move into the other two. So I think by and large, it is more or less determined by that some of those products which are in these two categories, basically the 28% and the 12% will be the largest beneficiaries. And I think if you distill it down product-wise, the obvious gainers are basically in the two-wheeler and in the auto space in general, particularly as far as two-wheelers and some of the four-wheelers also are concerned. Especially at the entry level or the value segment of the market. Those will be obvious beneficiaries. There will be also, some of the staple products which will also benefit. Although many of these did happen to be in the 5% category. So there will be a relatively lesser number of products which will probably be beneficiaries. But these are the two main, segments of the market which should gain as a result of this.
About that, and as we speak, these are the segments of the market which are doing extremely well as well. The top three gainers right now, as I see, are HUL, Asian Paints and ITC. Britannia thrown in there as well. Obviously not a part of the Nifty anymore. Tata Consumers, the other one, which is higher. So the top sectoral gainer is the Nifty FMCG, which is currently at the high point of trade. Tahir, ever since the budget announcement, the street was expecting a shift from capex to consumption. Do you think that was investable then and is investable now as well, or do you believe that money will be made only as of now in the capex plays, given the sort of problems that overall consumption, especially at the staples end, is facing right now, and the valuations at which these stocks are trading?
So Mangalam, when the first benefits were announced as far as taxation were concerned in the budget, that was essentially a bit of a starting point as far as the move towards consumption is concerned. It did not really happen at the expense of industrials to a large degree. It did for a while, especially during the time when we had that bit of the slowdown shock, and that the public spending was a little weak as well. But I think since then, since let's say the start of this fiscal year at least, we've seen even the industrial segment do reasonably well, thanks to the fact that even the government spending has held up pretty well during this period. But now that we are, we have this reasonably big boost coming on account of GST. There are still a little bit of question marks as far as um, the funding is concerned, and to that extent, it needs to be seen as to whether the government has enough levers in the budget to be able to kind of support both the segments. I would like to think that at this stage, it should be possible for the government to support consumption as well without actually deviating significantly from the fiscal path, especially if we were to probably avoid the tariff related hit. I think if that were to probably also compound as it looks like as we stand today, then probably things get a little tougher, and we'll have to see as to where the government's priorities lie, whether they have other avenues to be able to kind of make up for the shortfall and support both the segments so as to make it a twin track economy.
Okay. Got that point. By the way, I'm just looking at the fall on Mahindra and Mahindra. Stocks down about 3%. There is no fresh news as such. And this could be a complete off tangential shoot, but let's not forget that there are very, very big political meetings coming up over the weekend, the SCO summit and Prime Minister Modi's bilateral meeting with his Chinese counterpart as well. And a lot of thoughts have been tossed and thrown up in the air, including the possibility of opening up to more Chinese investment. I mean, could something like BYD be making in India as well? Again, this is all conjuncture at this point in time till we have anything definitive from those meetings. But perhaps that could be at the margin, something that is kind of in people's mind this morning. M&M down about 3%. Tahir, hi, morning. And actually, let me toss that to you. Maybe it's a question slightly ahead of time. But it's very, very clear that while our trade relationship with the US has gone into a cold storage, there is clear momentum and clear effort to revive a trade and business relationship with China. Now, do you see any implications, even at a broader level, at a surface level right now, for the listed ecosystem, whether it's our electronics companies, Amber and Dixons of the world, whether it's automakers? How should one start thinking about this? Because the shift seems to be in the making.
Yeah, it looks like clearly, and obviously it is born out of some of the circumstances which are surrounding geopolitical environment today. And I think at one level it is perhaps a bit of a shift in our own policy as well. And I think over a longer term it should hold up well. It should probably take away some of the shadows which surround Chinese investments and ability to probably have bilateral trade at a more meaningful level. It also probably lifts a little bit of the constraints from a few of the industries, some of the manufacturing-oriented industries, in order to be able to source raw materials and so on, so components, etc., as you mentioned. So I think it will free up some of the the supply chains which otherwise could have probably impacted India even more. I think we know that there are we probably are at this stage likely to see two supply chains develop around the world. They're already developing around the world essentially. One is a US supply chain and the one which is centered around China. And I think we'll probably have to see as to how we want to align ourselves. We've been significantly aligned on one side, and maybe we want to probably, there are some of these overtures that we are making in order to make sure that we are part of both the supply chains, at least for the foreseeable future. So I think diplomatically it is a good move in my view.
Tahir, absolutely, completely agree. But is there a risk of Chinese products undercutting Indian products? I mean, what's worked in many sectors, and these are high P multiple sectors, right, is import substitution. And if we are going to get stuff from China, they're going to get stuff from us. And I guess the market access here is a big one. Any thoughts?
I would think that, there are much of what we actually import out of China is essentially more of the raw materials, intermediates, certain components, etc. And that I think should not necessarily hurt us in terms of it affecting some of our local manufacturers, at least some of the finished goods product manufacturers. And in certain areas, we also have reasonable safeguard duties in order to ensure that pricing is not hit in the local market. So we'll have to see how that goes. But it's at this stage, Prashant, as you know, it is very incremental. We are seeing defreezing happen at in things like ability of Chinese professionals, Chinese nationals to be able to access India, to come to India, to be able to support some of the local manufacturers and so on. So that is the level of thawing of relations. We'll have to probably see how that further develops, but I don't fear that as much at this stage.
Right, we take that point. Tahir, in as many words as you can say without spelling out individual stocks, I have to ask you about Ola Electric. That definitely has been the stock of the month, up around 38%. The reason why I say that is because, one, from a government standpoint, there is the push that is coming in on two-wheelers and two-wheeler ownership. And the second part is the push that is coming in on electric vehicles as well. Add to all of this, the underlying fundamentals of the company, at least from what we saw in the first quarter results, seem to have been improving, along with the additional benefits that they get from PLI as well. Now, this is a high-risk bet. The stock has already seen a correction. Despite the rally that we've seen of 38% this month, the stock is still half from its 52-week high. How would you approach a space like this, which is fraught with risks, but, has seen such big moves?
So I think there are a couple of players which are, investment opportunities which are there in this space, and while we may not necessarily, as a matter of disclosure, have any exposure to Ola Electric in our portfolios, but we, again, as a matter of disclosure, we do have, exposure to, let's say, something like Ether Energy in our portfolio. So I think, by and large, we just to convey the point that we are optimistic about the space, and there will be players whom we'll back depending upon where do we see the strategy to be well placed, and the growth opportunity is still there in our view. So I think there's one segment which has held up reasonably well in the market for much of the players, even over the last some time, despite the fact that there's not really a big push as far as any other incentive is concerned. Of course, the government is now once again a little more amenable towards the segment, but otherwise it is having its own momentum simply because it is now trying to gain a larger part of the market share in the two-wheeler space.
That's on the EV side, Tahir. What about overall renewables and solar? Because there's a big fierce debate out there, and we've got a new listing that's just happened, and then there are companies like Wari, etc. And the debate is whether this is going to be only a short-term story till there is just overcapacity in our market. Of course, the companies say that they have a long runway of growth, but what do you believe in?
So I think it will be a typical scenario where we will probably see a burst of growth for the first 4 or 5 years, maybe the first 5, 7 years, perhaps, if not more, and then probably the growth will kind of maybe level out and trend more towards averages. So I think it's a typical scenario of businesses which are in the early stages of the growth cycle, and those will be there will be obvious beneficiaries. But I think these are also segments which have got other complications, especially with regard to imports, and and in that regard, we also know that some of these stocks have done well recently, simply because of the fact that we have moved closer to China, and once again that dynamic is at play out here in the very short run. But I think we are taking it step by step. We think that many of these companies, especially in the renewable space, both the product manufacturers as well as the EPC companies are in for that benefit of that very short, very strong burst of growth in the next few years, and then obviously we take it from there.
Right.
Okay. All right.
Tahir, thank you very much for joining us. Good speaking to you. I just want to, I'll toss to you just a quick word. And this is, basically pre-positioning or whatever you call it. The auto index is the top losing sectoral index right now. So stocks are up between 15 and 20% if you look at the August series. So in anticipation to the GST cut, stocks, auto parts, autos, everything, OEMs, so 1% lower. Guess what the index which is up the most, it is FMCG. FMCG index is up about 1.5%. And here you've got Colgate, which is up 4%. Britannia is up about 3%. HUL is up about 1.5%. Godrej Consumer is up 2%. Dabur is up 2%. So, buy the rumor, sell the news. That kind of story playing out, at least as far as auto is concerned. Clear, a big run over the last 1 month.
It looks like you see the auto index over the last 1 month of August, it's been up 5-6%. So therefore, now the profit taking perhaps setting in. And, like I was saying earlier, the law of diminishing marginal utility. So perhaps some shift happening to FMCG.
So perhaps some shift happening to FMCG, but for FMCG, it's more not by the rumor and by the news as well. This is just, there has been an underlying shift which everyone is expecting to come by for the FMCG space, and it has to be, put in context with the kind of underperformance that
Absolutely.
the FMCG stocks have seen as well. So we've been talking about the fundamentals of the sector, seeing some signs of improvement for the last 2 quarters.
And that was this whole conversation was on even before the 15th of August, before that speech.
Yes, so which is what exactly, is playing out in the FMCG space. But a couple of stray moves, particularly on Colgate, I'd like to bring, everyone's attention. The fear of the street was, and as, reported earlier as well, that maybe there would not be any incremental cut coming by on toothpaste. So it'll stay at 18%. But now the TIMSI has said that it's going to come down to 5%. There is an extra relief that is coming on that. But we also need to, again, put these things into context with regards to the penetration of the category. It's not that if my toothpaste becomes 2 rupees less, I will brush 4 times a day. The underlying demand situation has to be kept into context. Watch out for
दो बार तो बनता है.
दो बार तो मतलब वैसे भी.
Buy more paste and brush more.
Irrespective of the price, you do that.
Okay, actually on that note, let's get to the experts. GST is absolutely dominating headlines this morning. And we have 2 subject matter experts now joining in to talk about what this could really mean. We have Najib Shah, former chairman of the Central Board of Excise and Customs, as well as Prateek Jain, who is partner at Pricewaterhouse. And of course, he looks at indirect taxation very, very closely. Gentlemen, thank you very much for joining in. Mr. Shah, if I could start with you. I mean, it really is a bonanza when perhaps there were not such big expectations. The slabs being moved down from 4 to 2 and having that 40% sin rate. Do you think it will do the job? There is going to be some revenue loss, and we still need to see what shape and form that arrangement is going to take between centre and states. But do you see this being revenue neutral, or will there be a significant revenue loss? And if yes, will it be worth it to stimulate the economy?
Yes, to answer you precisely, yes, it'll be worth it. This is something which everybody had been asking for, hoping for, perhaps not as dramatically as it happened. Announcement from the ramparts of the Red Fort and so swiftly thereafter. So there's something which is good. It should stimulate demand in the economy. There will be a revenue loss for the states and the centre. Estimates vary from whatever, 85,000 to 1.5 lakh crores. And that will be something which will be a matter of concern for states. I think the GST Council's meeting will have to necessarily address the concerns of the states. And I have always held perhaps that some degree of hand-holding may be required and necessary. The government also will be closely looking at ensuring that the rate cuts translate into price cuts and are passed on to the consumers, because having taken this audacious, bold step in reducing the slabs, they would necessarily expect benefit to pass on to the consumers.
All right. How much would the impact, as per your assessment, given the data that we have so far, be on revenue, sir? We just want to understand, because the government also has to make this revenue neutral, right? Or maybe have the least impact on the fisc. Prateek, if you could do, some maths on that.
So look, there is a revenue impact, as Mr. Shah said. Of course, estimates vary. One is hearing about 1 lakh crore as an impact. But, in indirect tax, what happens is that when the rate goes down, it increases the consumption. And therefore, to some extent, the impact of revenue loss is neutralized. So that's one point. Second is, obviously, it will reduce the classification issues and disputes, etc., for the government. If you see, before GST came in, our revenue neutral rate, when it came in, revenue neutral rate was supposed to be around 15%. We have, before the rate cuts, around 11.5%. After the rate cuts, it could be around 10%. Now, at 10%, India would be placed at any other, compared to any other developed or developing economies in the world. And that's a very, very moderate rate to my mind. So there will be an impact. But in the long run, what we have seen with GST and earlier as well, then when you reduce the tax rate, the tax base increases. So hopefully over a period of 1 or 2 years, you will see actually the tax base increasing further, and the revenue loss to a large extent will be neutralized.
Gentlemen, morning. Great to have both of you here. Prateek, if you can talk some specifics, and we'll sort of go zoom into specific sectors and zoom out as well and look at the bigger picture. But cars, for example, right? And it's been keenly awaited. Luxury cars over 1200 cc over a certain length now will attract 40%. The rate goes up from 28 to 40, but they were the rate was already 40, right? Plus cess. So how does this work? And the cess gets subsumed?
Yes, so what we're hearing is, so obviously there was a rate with GST around 28% plus cess, and depending on the length of the vehicle and so on. In the smaller car, the cess was either not there or very small, right? So 28% there for the smaller cars. For petrol, likely to move to 18%, and diesel likely to again from 31% to 18%. So that's a big one. For bigger cars, there are two possibilities. One is that government might continue with cess in some form, right? Yesterday there was some discussion about is there a national calamity contingent duty which is going to replace cess. We have requested the government that it perhaps makes sense to replace cess and increase the GST rates per se. So if GST rates increases, then it could be 40% for bigger cars, but it will be still lesser largely than what you have today. But if they want to impose another cess or kind of a tax in lieu of cess, then more or less the tax incidence could be same as you have today, but it will not be worse off. So what I'm saying is that smaller cars will definitely get benefited from the looks of it. The bigger cars, either the incidence should go down slightly or should continue at the same level that you have today.
So, Prateek, hi, morning. I don't even know if it's possible to model this or not. Maybe I'll ask Mr. Shah as well. But with the changes and the proposal, as we know, in its current form, including things like, for footwear, the threshold might be hiked to now for hotel rooms, it's 7,500. For footwear and apparel, 2,500. Everything below these thresholds will be at 5%. Is there any way of modeling what the demand impetus could be? Prateek, I don't even know how one can kind of come to any sort of assessment, even category by category. Would you have anything on this?
No, look, for the bigger products, I think it's easier to simulate, right? So for auto, you can simulate that, okay, this many vehicles have been sold with the price elasticity and vehicle prices going down by 1.5 lakh. This will increase by so much. Similarly, you can do for air conditioners, some of the other consumer durables and so on. I think it's more difficult in a normal FMCG products like fruit juices and stuff like that. How do you really...
Okay, so let's talk ACs. ACs are basically durables and autos, the bigger ticket items. With the current changes being proposed, which is basically a 10% reduction in indirect taxation, 28% moves to 18%, which is big. By how much would you expect overall demand to be boosted up by? ACs and autos.
I will not take a guess on that. I'll say that it should be a substantial jump, right? It'll also, for air conditioner, also depends as to how the weather behaves and so on.
Sure.
But it should be substantial, right? I mean, 10% cut on vehicles, etc., translates into maybe 1.5 lakh or thereabouts, right, on the price itself.
Take your point. I mean, take your point. It's difficult to put a number to it, but it should be substantial. Take your point.
Then there is the tertiary impact or the secondary impact of perhaps lower rates on insurance and auto parts, etc. as well. I'm not sure.
No, absolutely. On insurance, and which brings me to the larger question of this whole input tax credit business. And Mr. Shah, if you could weigh in on this, many industries are saying keep us in the higher rate bracket, but don't take away our ITC. Insurers have been sort of asking for that. So how should we wrap our heads around this business of the 5% bracket not having ITC? Or would you expect some change there? Maybe offer input tax credit to some degree, even in the 5% bracket, because that's going to be a very large slab now.
It's a classic case of too much of a good thing. Nobody expected this sort of reduction in rates. And this having come, this is going to be a natural corollary is this accumulation of credit. Because it is extremely difficult to ensure that all the inputs which go in the manufacture of a final product are taxed in such a way that they neutralize the rate in the final product. So it's going to be very challenging. There are going to be concerns. I think there are going to be teething concerns, definitely. And the government will have to tweak as we go along and look at those rates. What can be ensured procedurally is to try and ensure that wherever there's any accumulation of credit, to have ways and means of ensuring that the industry is able to access that credit in whatever manner, right? So those are procedural issues which can be looked at to alleviate the concerns of input tax credit accumulation, which is bound to happen in the current scenario.
All right. Thank you so much for joining in and giving us your views on what may the impact be. We'll obviously wait by for the actual document that comes on September 4th and thereafter assess the impact once we have more clarity. Yes.
Maybe I'll just ask Prateek. Prateek, from what we've reported, you think anything kind of stands out to you which perhaps is a problem in the council? Or you think this is all what has been reported already? I thought largely on expected lines.
Largely on expected lines. I'll just say that what happens to the compensation cess. I think that's a big issue because the cess is there in the distribution chain, right? So if I bought a vehicle as a dealer, I have paid cess. Now suddenly when tomorrow I have to bill, there is no cess. So what happens to the cess which is there with me in my books? Will that be allowed as a refund or not? That's number one. Second is anti-profiteering. What are the guidelines which will come as to how do I pass it on to the customer? And how do I manage the transition stock, right? My stock is lying with dealers, with wholesalers, with retailers. So how do I manage that? How do I do stickering and so on? So some bit of guidance from that, from GST Council is expected. But
and on ITC, and also very quickly, if you could weigh in on this whole ITC dilemma, I mean, how can it perhaps best be handled and the transition be sort of smoothened out?
So on the transition, what they could do perhaps is to say that I can make an adjustment as a OEM, so as a company, and do a credit note to the dealers to the extent of tax amount. So I adjust the tax amount, I claim as a refund, and ITC for the dealer is reduced to that extent. So let's say a dealer has purchased something at 12%, he gets a credit note of 7% from the manufacturer. Something of that sort can come in, because if not, then obviously there will be commercial negotiation then in that case, because they will want some compensation for the incremental ITC which they're going to carry in their books for some time. So then there'll be additional discounts, etc., which will have to be offered by the manufacturers to the dealers and retailers.
All right. It'll be very interesting to see where this goes. As our guest earlier said as well, the devil will obviously be in the details. But two things are clear. If there is more money in the hands of people, irrespective of what the rates are, they are going to spend it somewhere. So consumer discretionary, just look at Trent, value fashion retailer, up around 3% right now. Again, this is a stock which has been an underperformer in the past. From its peak, it has seen a bit of a decline. 20-25% growth is what the company is guided for sustainably. This month, it's done well. And the second one is Yatra Online. That's up around 5% as well. Avenue Supermarts is the other one, which is up around 1.5%. So you have more money in the hands of people. People will spend it on travel, fashion, and perhaps some of the important groceries.
And let's not forget footwear. Relaxo is hardly relaxed this morning. A stock that Manglam had picked out. Now it's up 8%. Relaxo on the hopes that footwear below 2,500 rupees was going to be taxed at just 5% now. So there you see the GST chart busters playing out on the screen. Thank you, gentlemen, so much for joining in on that conversation. Very, very helpful and filled with perspective. We do have to take a quick break. Come back on the other side. We'll have with us Sajid Chinoy from JP Morgan to discuss the implications of this 50% Trump tariff on India and the measures from the Indian side, like GST. To what extent can they mitigate the impact?
Welcome back. We, of course, are trying to get an assessment of where we stand, right? There's efforts by the government to boost consumption, but that 50% tariff from the US, of course, remains a big overhang. Who better than Sajid Chinoy to take us through the thinking and how should we think about this in terms of impact to the economy? Head of Asia Economic Research at JP Morgan. Sajid, good morning. Great to have you with us here. Thank you very much for joining us, and sorry to have kept you waiting. So first cut, Sajid, how are you thinking about this 50% tariff hit? It's almost like a trade embargo for most products out of India to the US. While one hopes that this is not, obviously this is not permanent, and perhaps the 25 gets knocked off after some negotiation or something is worked out, but for now it's there. Go on, Sajid.
Morning, Prashant. Great to be here. I think where you ended was the key here. That there are two issues about permanency, whether we're at 25 or 50 for the foreseeable future. At 25%, even though we're higher than our competitors in Asia, we're in the ballpark, and there are other measures you can use to remain competitive and keep your market share alive in the US. At 50%, we're at a distinct disadvantage. And you know the math here. There's about 2.3% of GDP of India's exports to the US. A quarter of that is exempt, in terms of electronics, pharmaceuticals. So there's about 1.7% of GDP that's exposed. But what matters really is the value addition, because many of these sectors, gems and jewelry, have large import content. And the value addition here is about 1.1%. So there's 1% of GDP that's at risk facing the US. Now, I think the couple of important points to make here. One is that even though this 1% of GDP may sound like a small number in the grand scheme of things, as you know, this is concentrated largely in labor-intensive sectors, right? So it's textiles, gems and jewelry, leather, footwear. And so from my perspective, if you're presuming that this is a temporary shock and lasts a few weeks or a few months and not beyond that, the key is to avoid non-linearities, by which I mean the key is to ensure that, economic enterprises in those labor-intensive sectors stay alive, and there are no job losses there. Once you get into job losses, then you get down a spiral in terms of knock-on effects on consumption that are harder to reverse. Now, the good news is we have a playbook from COVID. This is exactly what happened in COVID, where, one fine day there was a sudden demand shutdown. And the question around the world was, how do you keep economic enterprises alive? And India has utilized a lot of those tools. And I suspect a lot of those COVID tools will come back, by which I mean, targeted support, both from monetary and fiscal. On the monetary front, it's more about liquidity, it's about regulatory forbearance. And from the fiscal perspective, it's actually more specific fiscal packages for certain sectors. The good news is technology allows you to target these sectors and firms very precisely, because these are all exporting sectors and therefore go through the banking system. So we can target them very precisely. And so I think that's the first order of business. Before we talk about a counter-cyclical response in terms of GST cuts and monetary policy, the first order of business is, over the next few weeks and months, presuming this is a temporary shock, how do you deploy those COVID-era tools to keep these economic enterprises alive and ensure that there are no job losses?
How much?
Sajid, just to get the numbers out of the way, so 25% India can compete, 50% complete, of course, it's an embargo. 1% of GDP is at risk, but you're saying that 1% is large because the indirect effect is much larger. And you're saying once you get into the cycle of job losses, etc., it becomes much more harder to contain. So immediately urgent sector-wise COVID-like support measures are necessary, right? Over the next few weeks.
That's right, Prashant. I would say days and weeks. And I say this because this is one of those shocks where the costs will, if this gets over in a month's time, that would be a demand shock that we can easily absorb. The longer the shock proceeds, my worry is the more the costs build, because the initial shock is a loss of demand. The secondary shock becomes the hit to employment, and then the knock-on effect to subsequent consumption losses because of employment losses. And then the tertiary shock is the longer this continues, that animal spirits, investment, China plus one gets impacted. Now, I'm hopeful, however, that this will not be a very long shock. The good news about US capriciousness is that we've seen this movie before with many other countries where standards have changed over time, and one fine day the US is amenable to striking a deal. So I think the key is, while we are undertaking these mitigation measures, we have to continue talking to the US, keep negotiating in good faith, and hope that eventually wiser counsel prevails on their end.
We take that point entirely. Sajid, just a two-part question here. One, immediately, what in your assessment could be the amount that should be deployed to support these sectors? How much would it cost the government? And then to the second point, you said, boosting methods of boosting consumption. The government has already foregone some amount on account of the income tax cuts that have come by. Then there are the PLI schemes, all those measures to, increase, growth out there, losing some of the government revenue, and then there are the GST cuts as well. All in all, the question is, how much would it cost the fisc?
And it's, these are very early days because it's not clear how long the shock is going to last. The longer it lasts, the more it will cost. I think the good news is because we've got a playbook that we've just used in COVID a few years ago, and given, the tremendous advances India has made on technology and the ability to target, enterprises and certain sectors, this needs to be, I think, a very targeted response, right? And because we can identify which sectors, which exporters. And I think the other element to consider here is that while this is 1% of GDP, the sectors that we're speaking about, the US constitutes a large market share in those sectors. And so I think ensuring that, these firms and sectors remain viable is the key. I think the fiscal costs, too early to estimate what they are, but I'll make a larger point. I think even if it costs the exchequer something in the near term, in the long run, this will more than pay itself back. Because if you're preserving the viability of enterprises, preserving employment, preserving consumption, that will more than pay itself back. Now, you raise a more important issue, which is if you step back, this is a year where we'll have to manage the fiscal carefully. And for no other reason, because, we'll get a GDP number today, which should be relatively strong, fingers crossed, close to, 7% almost. But nominal GDP today, I think, will be an equally important story. And nominal GDP is expected to soften to about 8% today. You could have a year where the WPI deflator is so soft that nominal GDP this year could be 8% or below 8%. Now, with that kind of nominal GDP, tax collections will need to be realistically assessed. It's hard to get 12, 13, 14% growth in taxes if nominal GDP is at 8%. The good news is we have some buffer from non-tax revenues, but we have to manage the fiscal carefully this year for these three reasons. A, you've got softer nominal GDP. B, you require some targeted fiscal support for sectors under stress. And C, you've got a GST tax cut. Now, the key there again is going to be how much of that is revenue neutral.
Absolutely. And I was just coming to that point, Sajid, to sort of cap it off. I mean, we can't control what the Americans are doing. All we can control is what we are doing, right? So you're saying more targeted measures. So if you could give us some sense of what is the fiscal space for what size of a package of measures for these sectors, A, and B, this GST cut. I was just asking the previous set of guests. Now, the estimates are that the revenue implication could be as much as 1 lakh crore, the revenue loss. It's not going to be revenue neutral. So then again, how does one do the whole balancing act and the adjustment? And will this extra spend, if I could call it, it's a revenue loss, let's just consider it spend, will it do the job of actually spurring the local economy, local level consumption here?
Yeah, that's a great question there. I think let's wait and see. I don't want to presuppose what the GST Council is going to say on September 4th and 5th. I think let's step back. Before we talk about revenue losses, the fact that we're reforming the GST, simplifying it, make compliance easier, is a hugely important structural reform. So I think that's the bigger picture here. Right, that you're going from 4 slabs to 2 slabs. If you make compliance easier, I think over the long term, this is unambiguously positive. Now, we need to be a little bit careful about, what the revenue losses are, because this is not temporary support, right? That once you reform the GST, again, another reason to do that is because the ratio of indirect taxes to direct taxes in India are very high. Indirect taxes tend to be regressive at a time when consumption needs support. Bringing indirect taxes down and reducing the cost of consumption, again, necessary, warranted. But I'm just being a little bit careful from the medium-term perspective because, if nominal GDP is going to be lower, then stabilizing debt means you have to bring fiscal deficits down. And the GST tax cut, as important as it is structurally, if there's a very large revenue loss, it's not a one-time effect, it's a permanent effect over the years. So we need to balance both these considerations. How much stimulus should you inject in the economy in a year like this? But how do you preserve fiscal sustainability in the medium term? I'm sure the GST Council will be thinking carefully about how to achieve this balancing act.
Absolutely. But I think the headline out of this interview, Sajid, of course, this very impassioned plea that the government must act and must act now over the next few days and weeks to support sectors which are hit and avoid, the cycle of job losses and, of course, what comes out of that. But I think point very well taken. Sajid, foreign flows have been very, very negative. I mean, continue to be extremely, $4.5 billion in August. I mean, big numbers, right? When in your conversation with clients, I mean, the dollar rupee is at a low. What is your sense on the fixed income rupee side? How are things looking?
I think clients don't worry about this for a couple of reasons. One is, yes, the capital account, has been volatile over the last year, FDI flows, debt flows, equity flows. But the fact is India's current account starting points are very benign. We have a year with current account, 0.6% of GDP in the year that just passed. Yes, there'll be some expansion if net exports get hit. If some of that 1% of GDP in value add gets impacted temporarily, the current account could widen. But the fact is that Reserve Bank of India is sitting on a war chest of reserves. So nobody worries about what the BOP implications are because there's plenty of ammunition and plenty of buffer. Two other quick points I'll make. I think given what's happening in the US, both cyclically and structurally, we're seeing the dollar weaken a lot. When the dollar weakens, it just takes the pressure off, emerging market currencies. If the Fed's going to be cutting, at least for the next couple of meetings, it'll provide relief to emerging markets. And thirdly, calibrated rupee depreciation in the next few months is not necessarily a bad thing. In a world in which, for example, our Asian neighbors have tariffs of 19 or 20%, and let's hope that, we claw it back to 25% or perhaps even lower. You want to get every percent of competitiveness that you can get. And so in a world in which the rupee is in a non-disruptive, gradual way depreciating, it's actually helping India's case on the export front. It serves to partially offset the impact of some of the tariffs. So I think, that's a policy choice that we will make, but really no reason to panic on macro. We can have a discussion on growth and jobs and consumption, but as we've discussed before, on macro fundamentals, when it comes to the current account, when it comes to inflation, when it comes to reserves, absolutely no concerns on India.
All right, that's great to hear. Sajid, fantastic conversation, and I hope Mumbai is listening. I hope Delhi is listening as well. Thank you very much for being here with a very astute sort of observation and, of course, what needs to be done from here. What we'll do is take a quick commercial break here. We'll come back and we'll focus on Mumbai once again. And there's a big conference which is kicking off. The Motilal Oswal Annual Investor Meet is kicking off from Monday. And we have two very busy gentlemen who will join us on the other side. They're right here in our studios. And we'll go across to them on the other side. Stay tuned.
Well, we were talking about the markets having started fairly well. Now it's taken a turn for the worse right now. The frontline indices are mildly in the red. The mid-cap index even more so. The story of the day so far can be summed up in the crisscross lines that come up for you. When we opened the markets, we had 1,500 stocks which are advancing for about 600 stocks which are declining. Now those lines have intersected and we have, 1,400 stocks which are in the red for just about 1,200 stocks which are in the green. That's actually a perfect time to weigh in on what investors are seeking from, everyone, the corporates, the institutions, and the whole ecosystem. So the 21st Motilal Oswal Annual Global Investor Conference, MOAGIC, as we know it, kicks off from September 1. For the curtain raiser, now we have Rajat Rajgaria, who's obviously the Managing Director and CEO, Institutional Equities, and Sachi Shahane, who is obviously the Head of Sales Institutional Equities, joining us in our studio as well. The conversation was promised. Thanks a lot, Rajat and Sachin, for joining in.
Thank you for having us. Thanks
at
for
a
having
time
us.
when so much is happening, the question is, what would be the top few questions on everyone's mind, and what are you doing to ensure that those questions will be answered?
Yeah. So, this 21st edition of our conference is happening on a very interesting backdrop.
Yes.
The last 1 to 2 months of events have given a lot of reasons for people to engage with companies, with investors, to find out what lies ahead. When we started planning for this conference, it looked like a one-way street this year for India. But I think 2-3 things that have happened. The last quarter earnings have not been that great. We are still grappling with a single-digit earnings growth. Second, I think you are seeing this entire tariff, and suddenly it looks like that this tariff war is like for us only in this world. And the third, So we are seeing now RBI and government both coordinating very well to stimulate the economy in every possible manner. All these factors have important consequences on every company that comes at the conference. So I think investors would have very directed questions to know from the companies to what extent they get impacted by all of these and what are they doing to mitigate this, right?
I'm curious to know, when you say investors, what are the queries already? What is the participation going to be like from the foreigners?
Yeah.
Because they're the ones who've been sitting at the edges. And in fact, because it became very clear, like you were saying, that India is being singled out, and as it became more and more apparent that we're not getting a trade deal immediately, the selling intensified. It was 17,800 crores last month. August now, it's now almost 30,000 crores. And they're going to other markets. They're going to Korea, China, which is okay.
Yeah.
But what's the sense you have from the foreign participation side?
So, we have large teams from multiple long-only global foreign investors, be it the sovereign funds or be it the largest of the investors, right? But I think, let me give you a flavor that when you look at Motilal Oswal conference, when we say it's a large conference, we have 1,200 plus investors who attend this event. We have closer to 200 companies. But more importantly, our track, which features 16 speakers, and these are speakers from all walks of life, listed, unlisted, corporate expert, right? It's not just about a stock conference. It's about a framework. It's about a philosophy. It's about how do you see this country. This is a century of opportunities. We just completed a quarter of a century, and we all have been benefited from this quarter of the century growth, right? Last 25 years, we grew from a base of 400 billion, 10% compounded, to today reach 4 trillion. Next 25 years, we will grow at 10% compounded on a base of 4 trillion. So imagine you are going to build one India next year, which existed in 2000. I think this conference is about how do we widen our scope of investing so that we capture the bigger opportunities, point number one. And point number two, of course, while the big picture remains always good, in the short term, you have to face the adversities to make sure that you don't get caught off guard.
So foreign participation isn't lower this year at the conference?
No.
Compared to previous years?
Yeah,
no. There's
no.
Adequate interest.
In fact, I would say that the domestic participation is just growing every year, as you can see in the market, and as you can see in our conference.
आप सारे FIS को एक conference room में बंद कर लीजिए.
Just lock the door from outside.
अब आप तभी निकलेंगे.
See the big picture.
Per person, $1 million.
Right वाला बटन दबाएंगे आप.
That's a good idea.
मैंने बोला मत बोलिएगा, but you must have seen Akash Prakash wrote a piece recently saying valuations still kind of high relatively compared to EMs, but he said his point essentially was, the punch to me was, you can't have an expensive market with just 10% kind of earnings growth, which you also alluded to, that earnings growth has been kind of poor. And that is the reason why, and this question, why are FIs such big sellers? And Sajid just told it has nothing to do with tariffs, this 50%, etc. It's earnings growth. We spoke with Rajiv Batsra of JP Morgan, who kind of also identified poor earnings growth as the number one reason. What is your sense, Rajat? Is this a write-off year? Do we need to roll over to F527, which the market anyway will do? What's your sense?
Yeah, I think bang on. The single most reason for our market underperformance is earnings, right? If we grow at 15-16%, 20p is attractive. If we grow at 5%, 20p is expensive.
Right.
Our PE is not going to come down. So if markets will stay here till the time the earnings growth don't happen. Point number one. Point number two, whenever earnings growth aggregate is slow, whichever pockets grow, they get disproportionate premium.
Yeah.
So even in today's market, I can tell you 5 stocks which are still doing very well, and they were not that they are surprisingly doing well. They were supposed to do well because their numbers were doing well. So that's the second point. Third, on the aggregate earnings, I think there are some both structural and cyclical factors which have come together to make this 5% growth coming, right? Like IT, which has always been a bedrock of earnings for corporate India. I think structurally they are into a single-digit earnings growth mode now because of the way businesses are shaping up. But many of the domestic consumption, industrials, financials, they have to come and make up for that. They are in a cyclical low right now. And I'm more positive that the low base of the last 12 months, a lot of the stimulus which has come from RBI already, which will take effect, and the government stimulus which is likely to come over the next few months should at least push our aggregate growth rate from this 5-6% to more like a 12%. Is 12% good enough? That markets will decide, right? But I think the P's are unlikely to contract much. The earnings has to move up for the market performance to return.
So to that extent, then the obvious question is to the corporates that you're getting on the conference. What is the mix of those corporates like? What sectors are they predominantly from? You said unlisted, listed. And what do you think would be, their idea on growth in earnings? I mean, because earnings growth is what will drive the market, everyone will be asking those questions to the corporates as well. What is it that will drive your earnings growth? Because you can, on the one hand, speak about the macros, blame the macros, or benefit from the macros. Eventually, it is your company's doing that will take the earnings higher.
Absolutely. So, I think this year is also a transitory year on many regulations impacting the earnings. For example, if you look at capital markets, you had regulations which came in, especially on the broking side, which has impacted earnings. If you look at, suppose, the GST cuts, we keep hearing there can be postponement of purchases, which can lead to some inventory impact. That will also come in. If you look at the way this tariff thing can kick in, right, this will also have. So I think people will at least try to focus how much impact in the very short term is going to come. But more importantly, there will be some businesses which will weather this very well. We have 180 companies at the conference, but each investor needs just 5 ideas.
That's what. So I was going to ask you, so which are the five fastest growing companies of, let's say, FY27, which will come at the conference?
Or the tracks where most amount of investors have said, okay, this
I'll assure you, I will come next Wednesday when the conference gets over.
Just to share
something a little more flavor on the companies.
Yeah, so just to share on the question which you just asked, so a lot of interest in logistics names, a lot of interest in consumer discretionary, industrials.
What companies would they be? And you have unlisted as well. So where is...
But these are largely listed names which I'm talking about, where there is, so all the listed names in this space. And as Rajat just mentioned, non-lending financials is again a very big space where there is...
Unlisted companies at the conference?
Roughly about 15% of the conference would be unlisted.
And how much of that 15% is up for listing next 1-2 years?
Not at least the next 6 to 12 months.
And from which spaces are the unlisted companies?
Essentially, new age, consumer, logistics. Look, because I think unlisted companies come with a very different perspective to share with investors, right? So we always try to make a blend of at least 15% of the conference to be unlisted companies.
So a lot of interest you said was on logistics, consumer discretionary and non-lending.
Industrials, non-lending financials and auto anks as well.
What about the IT guys? You said, it's structurally low. I'm sure at this point in time, a lot of the investors would want to know what are they doing to mitigate this AI storm which is coming in? How is it that my IT portfolio can look a lot better? How will the earnings increase?
Yeah. So, in the case of IT first, their corporate access anyways is top notch. They meet people very frequently. Their quarterly disclosures is pretty high. So it's very little to again figure out we still have good participation, but I think businesses are more predictable right now, even though they are slow. In a conference, I think people try to figure out 2 things. Stocks in my portfolio which I think are not going to grow well, and stocks in my portfolio which I don't have which are likely to grow well. So that kind of an adjustment people want to do. I think suffice to say that 1,200 investors, 180 companies, roughly about 15,000 meetings that we are doing, right? Each one of the investors is getting their share of what they want, right? Hopefully, at the end of this conference, they get some actionable to do for themselves.
I asked this question to Ramdev ji just the other day. Yesterday, we had him on, right? And I was asking him what the local HNI money is doing, the non-retail money. The retail money is nicely doing their SIPs and they're keeping the market up. So he was laughing about it. Jokingly, he said that the problem with that money is that it'll be on the sidelines. Jab tak bazaar thanda hai. The moment there is momentum, they'll all quickly jump onto the bandwagon. But your assessment, you or Sachi, the one when you talked, because there are large participants as well. So the non-mutual fund domestic money that we're talking about.
So just to share a data point on that, the AIF side, which is largely the HNI and very high net worth retail money, that is seen commitments of almost 14 trillion. Which is a jump of 14 trillion INR, I'm saying. So that is a jump of almost 20% year on year. This is a data shared by SEBI some time back. And of which still there is a dry powder of almost 8 trillion, which is sitting on the sideline.
8 lakh crores of
8 lakh
HNI
crores.
liquidity.
AIF money sitting on the sidelines.
And a lot of the HNIs are interested in not unlisted. That's
Amazingly.
that is
I was
where
just focusing. If you look at today, NSE shareholding. In the last 5 years, the entire VCP, FII holding has come to India, to the HNIs and the family offices. You looked at the Zepto deal that as a house we did, a large number of HNI. I think a lot of the HNI money, what Prashant is mentioning, is finding way, right? Typically, that used to be the space for private equity or funds that has become for...
I'm not joking, Rajat. I was talking to a venture capital fund in Bangalore, and I was just chatting about strategy. I said, well, looks like some of these guys in Bombay have more companies than we do. They've been in the VC fund for 20, 25 years. So it's absolutely correct. It's completely transformed last couple of years.
That's something that Uday Kota keeps quibbling about, right? That the second generation is now looking at venture capital investing as against...
No, these are old, 30-year-old veterans in the market, public market investing, who now they're kind of doing backward integration. They're going,
offices, but
finding companies earlier and earlier in that sense.
So, we focus a lot on the mutual fund daily flows, monthly SIP flows, right? What we don't capture is the non-mutual fund flows into the equities, which come in multiple forms. Insurance, HNI money, AIFs, etc. That someday, I think somewhere we will...
Motilal Oswal should come up with a report every month on the
quarterly.
We will do that. Thank you. That's a second idea. First idea was to lock people into...
No.
Second idea.
The second is the more actionable idea.
It's a very doable idea.
It's all the best to you as you organize this massive conference. It's always great to have both of you to kind of sort of preview the conference for our viewers. Really appreciate it, Rajat, Sachin.
Thank you.
Thank you.
Have a good time.
Thank you.
We'll take a quick commercial break here. Don't go anywhere. We'll come back in just a bit from now. And it's the economy with Lata. And there's a lot to discuss. I mean, the GST news break from last night. And of course, the 50% tariff implications for the economy. Srinivas Varadarajan is of Deutsche Bank India. He'll be the guest on the program in just a bit. Stay tuned.